everyone, welcome. In this video, we will focus on a quick understanding of installment sales and property transactions. So an installment sale involves selling property where at least one payment is received in the year following the sale. So if you make a sale this year, and this is all the money that you receive this year, that is not an installment sale, right? So if you get one of the payment this year and then you receive at least one more payment next year, this qualifies the transaction under the IRS rules that this is an installment sale, that you can apply the installment sale treatment. So this method is applicable only if the sale results in a gain. So if you have a profit, you can use the installment sale method to reporting the sale. But if you have a loss, then you cannot use the installment sales. So payments in installment sale typically comprise of three components. First is the interest income. So this is reported on Schedule B. Second is the return on adjusted basis in the property. So think about it as a return of capital, right? The money that you put to pay the money, you recover your cost that you put in the money, right? So this is non-taxable, right? It's because it's only the return of your investment, the return of your cost. And the third thing is the gain on the sale. So the gain on the sale is reporting on Schedule D or Form 4797. So to report the installment sale, you need to report the Form 6252. It's called the Installment Sale Income Form. It is used to report such sale in the sale year and also for subsequent payment that you receive in the future years. The calculated gain on Form 6252 is then transferred to either Schedule D on your Form 1040 for capital gain asset sales or to Form 4797 for business property sales. Depreciation recapture is reported in the sales year, even if all installment payment hasn't been received. So the sale price should exclude interest, whether it's stated or unstated. So this court is focused on the primary home. So for the primary home, for this process, you should not have depreciation recapture. So you should not have rented it out at all, or you should have not take home business depreciation, like the business use of home that have a component of depreciation to it. So let's go back. So the sale price should exclude interest, whether it's stated or unstated. Let's go back to the installment sales. So depreciation recapture, this is just general information. Depreciation recapture is reported in the sale year, even if all installment payment hasn't been received. And then for the calculation for the Form 6252, the sale price should exclude interest, whether it's stated or unstated, meaning that you specifically say on the contract that this is the interest that I'm going to receive or the buyer going to pay me, or there's no mention of interest unstated. The sale price includes the total amount you are to receive. Also, the fair market value of any property you are to receive. And then also any existing mortgage or debt the buyer assumes. And any selling expenses paid by the buyer. And the next component that we need to calculate is the adjusted basis, which is comprised of the adjusted basis, the selling expenses, and depreciation recapture, which for this course, again, we don't have depreciation recapture. If the sold property was the taxpayer's main home, the gross profit is reduced by any excluded gain. So the gross profit calculation is follow. So gross profit equals sale price minus adjusted basis minus excluded home sale gain if applied. And then the next number that we need to calculate is the gross profit percentage, which is you take the gross profit and then you divide it by the sale price. The next step, we want to calculate the taxable gain calculation. So the taxable gain from the installment sale for each year equal the gross profit percentage that we just calculate above times the payment received during the year, excluding interest. If the sale price changes after the sale year, the gross profit and percentage must be recalculated and applied to the remaining payments. Any installment sale income reported previously is subtracted from the revised gross profit to get the new percentage. Taxpayer can choose not to use the installment method by reporting the entire gain on the sale year. The gain is reported on Form 8949, which flows to either Schedule D on Form 1040 or Form 4797 as applicable. This election must generally be made by the tax return due date, including extensions. If it's not made initially, it can be made via an amended return filed within 6 months of the original due date. You can write file pursuant to Section 301.9100-2 on top of the amended return. After making the election, it can only be revoked with IRS approval. So there you have it. This is just the general information on the installment sales. I understand it's going to be way more complex, but if you have your basic number, you can actually use TurboTax to guide you through the process. So let's move on to that next.